First, I want to share with you what happened in the capital market over the last few years. So I'm going to speak about the commodity markets. How did the industry survive? Because you will remember that it was a very tough time. Then I'm going to speak about the new capital markets that surfaced over the last 2 years. I'm going to speak about the new projects that's in the market and whether we were ready or not. Then the new wave of capital projects that surfaced, current project models that we see in the market, and then additional role players. There's about 90 design houses at the moment that we're dealing with. And lastly, the commodity outlook for the next few years. So as you know, during the time from 2011 to 2016 was very tough times in commodity markets. You will recall that the commodity markets plummeted from February 2011 to January 2016. And during this time, there was also a lot of retrenchments in the market, especially by other equipment suppliers and design houses. If you look at this graph, the blue at the bottom is the number of dormant projects in Africa. The red is the grassroots projects in Africa. The light green, the pre-feasibility projects, and the purple is the bankable feasibility projects. So in total, there's about 2,000 new projects in Africa. During the very tough financial times from 2011 to 2016, only 0.1 to 1% of these projects were moving into execution. So basically, if there's no money and commodity prices are plummeting, nobody is investing in new projects. So that means that 99% of all projects were suspects and they were not in execution. And during this time, a lot of design work was done on pre-feasibility and bankable feasibility stages. The reason for that was for the big mining houses to wait for commodity prices to pick up, and then the projects would move into execution. So the question is, how did we survive during those very tough times? What did industry do? How did we manage not to retrench people? One of the interesting things was that it wasn't specifically the bulk commodities that pulled us through, but also some critical minerals. And we saw a huge increase in fines beneficiation and tailings projects. And one of the reasons why we as Multotec survived was because of our diversification, and also because I think we had a very good understanding of the commodity cycle. Okay, Roy touched on to this slide, so I don't want to go through this slide again. But the main thing is that Multotec is has got diversification, and therefore it's easier for us to survive in very tough times. So new capital markets were surfacing. You will remember in the 80s that only a few bulk commodities was mined. So basically the coal, the iron ore, then there was also gold and diamonds. But now, 30 years later, just about every mineral on the periodic table is being mined. And the most important thing is that we must be ready, and we must adapt our processes to make sure that we're ready to mine new commodities on the periodic table. I want to touch on to critical minerals. And what happened in 2010, there was a huge scare by China. So China basically told the world, we're not going to supply rare earth minerals to the rest of the world anymore. Now, rare earth minerals is associated with magnets and electrical motors. So now you can just imagine the scare. What the OECD countries then did was, they identified critical minerals all over the world, and they identified the high criticality and the moderate criticality minerals. And what we saw was that over the last year or two, a lot of the projects that we were involved in was in the high criticality and the moderate criticality mineral range. And you can see some of these highlighted in green, and these are specifically the projects that we were involved in 2017. Now you might ask me, what is a critical mineral? A critical mineral is is a mineral that's associated with economic importance for the whole world and also a supply risk. Now, the supply risk looks at things specifically like the concentration of production. Where is most of these minerals produced in the world? What is the concentration of reserves? A very good example is cobalt in the DRC. What is the political stability of that country where these minerals are being produced? Is there another mineral that you can use to substitute this mineral? And then the last thing is recycling. You might know that about 30% of the world's minerals, of the world's platinum, is recycled already. So if we look at the high criticality area, a lot of the projects that's moved into execution recently was in that high criticality area. Now, for South Africa, we're fortunate because 3 of the world's highest production minerals is in South Africa. First of all, it's chromium, 45%, it's PGMs, but South Africa is also the biggest producer of manganese in the world. And then another commodity that we've also benefited from is cobalt. 64% of the world's production is from the DRC, and that's on our doorstep. Now, if you look at the Fraser investor survey and you specifically look at investors' sentiment, it's important to see how investor sentiment has changed from 2013 to 2017. The top countries in Africa is Ghana, Mali, and Botswana. Okay, if you look specifically at investor sentiment. The biggest losers over the last 5 years was Kenya, Morocco, and Mozambique. And we definitely, we've seen the influence on the phosphates in Morocco. The biggest improvement over the last 5 years in investor sentiment was Zimbabwe, Mali, and DRC. And it's very interesting because a lot of our projects actually come from Zimbabwe and the DRC, and some of our biggest projects came from Zimbabwe and the DRC. And that's all linked to investor sentiment. Now, I want to talk about a new wave of capital projects. Okay. Over the period between 2011 and 16, January 2016, we said that commodity prices plummeted, and we definitely saw the effect also on Multotec's capital projects specifically. The interesting thing is that there's about a 7-month lag between commodity prices changing and us seeing the orders. Okay, so first of all, the boards must decide whether the project moves into execution, and from there, we then about 7 months later, we see the orders coming in and the projects moving into execution. So a lot of work was done over this 5-year period without projects going into execution. So that's a 7-month lag. The commodity prices changed in January 2016, and we as industry saw it in August 2016. And this was also predicted by the biggest design houses in South Africa. So there you can see exponential growth in our order capital performance, and that's the green line. So the blue line is your commodity prices, and I'm referring specifically to the metal price index because the metal price index has got the closest correlation to what we see in capital. And the reason for that is that the commodity metal price index is a combination of a whole lot of different commodities, including things like iron ore and copper. Okay, so we saw exponential growth in our capital performance, but that's also due to the work that was done in the 5 years while commodity prices was low. All right, what we also, I think, realized over the last few years is the consumable business is very different to the capital business. If we talk consumables, we talk big volumes, we talk high wear, and we talk bulk commodities. If we talk capital, there's definitely bulk commodities in there, but it's usually tailings or fines retreatment. But the critical commodities has also played quite a big role in our capital order intake. And I would say the critical commodities is the icing and the cherry on top. Now, if we refer back to the critical commodities, you will remember the high criticality area that we referred to if you look at economic importance and you also look at supply risk. Now, the green circles is the sizes of the orders we had in 2017, okay? And interesting is that a lot of the big green circles are in the highly criticality area. And that's basically saying that a lot of critical minerals has moved into execution. All right, what happened in 2016? You will remember with electrical cars and the battery market surfacing. In 2016, we had the lithium love, and immediately we were involved in 5 lithium projects. All 5 was in Australia, but it was local design houses doing the execution. Then, as the lithium price became too high and lithium became very expensive, in 2017 we saw the cobalt craze. And with the cobalt craze, we obviously also saw the projects surfacing. But these markets are very small and they're not always sustainable. So the timing is very important. Then this year is the nickel noise. Although we don't have a lot of products that's suitable for nickel, a lot of design houses are very involved in nickel. And for the first 6 months of this year, nickel has done the best with regard to commodity prices. All right. Now, why the hype about critical commodities? If you look at 1 ton of iron ore, I'm not sure exactly what the price is today, but it's low. It's maybe $70, $80 per ton. If you look at 1 ton of tin that's got a very similar process of recovery, it can be anything up to 20,000 or above US dollars per ton. So this is what the whole hype is about. It's about commodity prices, very high commodity prices, excellent return on investment, and there you can see it's about 270 times the price for 1 ton of tin. And that's also why we see a lot of artisanal miners being involved in these critical commodities, especially in the DRC. It's very rewarding. Okay. There's about 40 million artisanal miners worldwide, and we've seen a steep increase in the number of artisanal miners that's also talking to us at Multotec. Interesting is that in the world, about 80% of the world's sapphires are already mined by artisanal miners, and then on gold, tantalum, tin, and diamonds is around 20 to 25%. So the artisanal miners is also definitely a force that we must reckon with, and we seeing a lot of them visiting South Africa and also Multotec. Now, the question with regard to these critical minerals is it as good as it looks? Okay? And the answer is there's a catch. With the critical minerals, the demand is small and it's quickly oversaturated. And the market is very quickly oversaturated and the critical minerals are very expensive. So when you look at the iron ore market, you can see it's absolutely massive compared to the other minerals, which is mostly critical minerals. So the markets for the critical minerals, the time span is very short. And that's why we saw lithium in 2016, cobalt in 2017, and then nickel in 2018. I quickly want to touch on to how all of this in commodity prices has influenced the projects market and then the additional role players. Okay, we don't see a lot of Greenfields projects anymore. Greenfields projects is usually projects that's new operations and they're not in production anymore. In 2017, the only new Greenfields project in South Africa was the Gamsberg project. Greenfields projects are expensive and a lot of the mines all of the mines are already in execution, mostly in South Africa. So what we see recently is a lot of brownfields projects. Brownfields projects will refer mostly to repair, upgrade, replacement, rebuild, or additional plant. Also a lot of tailings retreatment and fine treatment. Brownfields projects, however, is very difficult and there's high risk. And the most important thing with brownfields projects is to make sure that we mitigate the risk, because you cannot stop production for an hour while you want to tie in, and therefore it's important that you keep tabs on the risk. A new generation of projects has surfaced. We've seen more boot and boom projects where you basically own, operate and maintain. That's very similar to a rental agreement. And especially the small miners that doesn't have funding, they usually request boot and boom projects. We also see mostly EPC and LSTK projects, and I will touch onto that now. But the whole project model has changed over the last few years. So a lot of requests for modular, mobile, phased approach projects where you start generating revenue with maybe one model, and as you're generating revenue, you will add additional models on. All right, and then of course there's a premium to be paid for a rental agreement, especially if you do a boot. A lot of companies are doing build, own, operate, and transfer, where they transfer to local communities in order to do a social responsibility. But there is a price to be paid. All right. Now, in the olden days, when I started in mining, most projects were EPCM. Everybody was driving technology, and there was a lot of money in the mining industry. Nowadays, or just about all the projects has moved to an EPCM or EPC LSTK model, where price is absolutely key. The projects has got a fixed timeline, and the prices are fixed. So it's a much more difficult mining environment to do business in now. Also, when you look at project phases, I was used to projects taking anything between 3 and 7 years. And the projects usually went through different EPCM stages, like pre-feasibility, feasibility, detailed design, and execution. Nowadays, the majority of projects comes in right at the end at LSTK EPC. And it's very important then to understand that the timeline of that project is very short and the pricing must be very accurate. Also, when we look at shareholders, I think many years ago we used to sell on relationship. Projects was EPCM. It had lots of different stakeholders. The stakeholders was the mine, the engineering manager, the consultant, the design house. Everybody was stakeholders and everybody had a say. Nowadays, with EPC, LSTK projects, on a lot of projects, there's one stakeholder, it's a design house, and we don't always even know where the plant is going or where the equipment is going. All right, then the number of design houses has changed considerably. 5 years ago, I think we started with about 35 design houses. Currently, we're working with more than 90 design houses. And most of the design houses is geared towards the LSTK EPC model, where it's a smaller design house, they're doing projects at lower cost, and the projects move very quickly. There are still a few EPCM design houses that does the big projects. Okay, commodity outlook. All right. These are just figures, 2018 figures, recent figures. The outperformance over the last 2 years, it was nickel, precious metals, and uranium is slightly increasing. The winners, like we've mentioned, lithium, cobalt, nickel this year, and copper is also doing well. And then the stragglers has been reported to be coal, but we've definitely seen an increase over this period also in the price of palladium, and the forecast for rhodium is still fairly optimistic. If we look at critical minerals long term, the demand is definitely there long term, although it's a very small market. We must keep that in mind. So it won't be huge, but there is demand, especially if you look at minerals that's influencing Africa. That would be graphite, nickel, alumina in East Africa, copper. We've got very few lithium deposits, cobalt obviously in the DRC, and then manganese, where South Africa is the biggest producer in the world. All right. Unfortunately, the forecast is not very positive. So when you look at commodity prices now, and you look at commodity prices second quarter 2019, I don't want to say just about every commodity the price is going down. However, the margins are still good on commodities such as gold and manganese. All right, so it's important to look at the commodity prices, but it's also important to look at the gross margins of these commodities. All right. Again, I don't think there's a single mineral where the forecast is more positive until second quarter 2019. However, the margins are good for copper, cobalt, coal, tin, obviously, nickel margins is good, and iron ore is also good. All right. If you look at very long term, and it's always good to look at that for capital projects because it sometimes takes many years to build new mines, the long-term forecast is good for aluminium, copper, and nickel. Okay, so yeah, I was telling you about how commodity markets plummeted. Okay, how did we survive? Because of our diversification and fines beneficiation. I've touched on critical minerals and how that helped us on the capital projects. Okay, we also spoke about flow sheet development, how we adapted to these new markets in the capital side of the project. We spoke about the new wave of capital projects and how quickly they move and how small these markets are. Then we also spoke about the models that's used nowadays, like your boots and your booms. And then we spoke about all the additional role players, the 90 design houses that we had to start seeing. And then the outlook, very cautiously optimistic. Thank you.